Now, what are the implications of raising, funding from external investors, specifically VC and PE investors, on the company, on the founders, as well as on the finance team? Um, it becomes very critical to have a very, very clear sense of the company's growth plans and the capital requirements. So if I am running a bootstrap company, it is my choice. I can choose to grow in a certain year. I can choose to pull back on growth, maybe focus on profitability or consolidate my position. But once you have raised funding from investors, the clock is ticking and you are under obligation to deliver a certain return. So you have probably promised a certain sort of growth trajectory to investors as well. So you are under pressure to actually deliver that, right? And the other element of it also is in terms of capital requirement and runway. It's very important to understand this, to monitor this in the right fashion, because most early stage startups will be loss making. You are dependent on external capital for survival itself. So if I miscalculate, if I mistime my fundraise, I may be in a situation where I may be running out of capital. I may be under pressure to accept capital at a lower valuation from my existing or from new investors. So to have an eye on these parameters becomes very, very critical, and to have them aligned with your investors as well is very critical. Alignment also, like I said, in terms of with the investor, in terms of return expectations. So to take a business where I can reliably expect a 25 to 30% sort of return on equity, and to go raise funding from a venture capital investor may not be the best of things too. Because if your VC investor wants an extremely sort of hyper growth sort of situation, and they want to see a multi-bagger on their investment, so to go with a business which may not be as high risk, but it scales slower than their expectations, may not sort of really work out well in terms of either for the investor or for the founders. So it's important to be aligned with what the investor expects to see in the company. In most cases, the funding round may not happen if this alignment is not there. But the consequences of not having alignment and getting into something, getting into a relationship with investors, will be very tough for the founders and investors as well. The competitive scenario when it comes to fundraise also is sort of important to consider. If you're in an industry where the competitors are raising funding or having access to capital, that makes it fairly tough in terms of you as a company. So can I choose to remain bootstrapped and grow at my own pace? May not be the case if my competitors are deploying funds in the market and trying to gain market share. So what are the competitors doing? How well are they funded? Am I in an industry with a lot of well-funded startups? And that should determine how quickly I should grow, how quickly I should consume capital as well. Exit for the investors and for the founders as well. And the timelines for such exit should be considered. So as a founder, if my intent is to run the company for eternity, and if I really want to get to a point where I see myself running a listed company, then it's best to tell the investor that yes, an IPO will be the best mode of exit for all of us, and you get your exit as an investor. But if a founder is very clear that, okay, I'm going to run this company for 5 years and I don't see myself running a listed company, then it's important to start thinking of options to get a strategic investor in place and to get a controlling, for an investor who will take a controlling stake. So how are you as a founder, or how is how is the team, the management team, really thinking about exit? And do those thoughts about exit align with your investor? And do they align in terms of mode of exit as well as timelines? That is something to be considered. One of the key, elements in terms of the thinking of the founder when they go down the path of raising funding is that in most cases the founders will be bootstrapping their companies. They have 100% control of their companies. Now, once you've ceded partial control to an investor, you will be in a situation as a founder, as a management team, where there will be an investor and a board oversight. So there will be a professional board of directors, the investor and the founder. The founders will be part of the board. The investors also, in most cases, have a board seat. And now the management team is now answerable to the board. This distinction may not be very relevant in a bootstrap company, but becomes very, very important in a funded startup. So it's important for finance professionals to advise founders in the right way, to sensitize them to the fact that now there is a separation in terms of the board versus management, and there is an obligation to sort of report to the board and take the board's consent before undertaking such an action, which again flows into the next set of it, controls and corporate governance. So I would say more specific for the finance professionals in the company. So you have multiple minority investors in the company. You have an obligation to them. You have an obligation to the founders. It's very important to have a system of controls in place, because as a company, you are scaling up fairly quickly, and you don't want situations where there are leakages in terms of revenue, in terms of cost, or having weakness in terms of controls. And this is also very critical from a corporate governance perspective. You have an obligation to minority shareholders as well, being the head of finance in a startup. And you need to ensure that their rights are also protected while you do continue to work for the founder. So these are a few things to keep in mind, in terms of how companies prepare themselves, both mentally as well as an organization, for raising funding.